Secured and unsecured business financing that you can get right now for your business. Secured financing is financing that is obtained using some form of collateral. The collateral serves as security for the debt. If the borrower defaults, the lender can take the collateral that was used as security. The lender will then typically sell the collateral at auction or have a professional in that area handle the sale. The lender's goal would be to unload the security quickly, which is why much collateral is given a fire sale value initially. Secured financing examples on the consumer side might include a car loan, a home mortgage, a signature loan. Most common business collateral types include account receivables, equipment, inventory, purchase orders, commercial real estate, auto floor plan, insurance book of business. Most common personal collateral that can be used for business financing include stocks, bonds, and other securities, 401ks and IRAs, cash in hand, even residential real estate. Private money is one type of secured financing. To get approved, you will need 2 years of positive financials. You also must show positive sales growth. Plus, you will need to have 20% collateral. Rates are typically 8% or higher on this type of business financing. You can usually get approved for a working capital credit line. 650 score are typically needed to qualify. SBA loans are also a form of secured financing. To get approved, you will need 2 to 3 years of positive financials. SBA loans are completely full doc, meaning you will need a lot of supporting income documents. You also must show positive sales growth, and you will need to have 50% collateral to get approved. Rates on SBA loans are typically 5 to 8%. 10 to 25-year loans or credit lines are available. Good credit required for approval. Account receivable financing is a type of secured financing in which outstanding receivables are used as collateral for business financing. With account receivable financing, you can secure financing for up to 80% of your receivables, and you can secure those funds within 24 hours after initial approval. The other 20%, minus the lender's fee, is released once the actual invoice is paid. This type of secured financing is not a loan. Instead, future receivables are being sold for a discount. With account receivable financing, you can be approved for between $5,000 in financing all the way to $20 million in financing. 1.25 to 3% discount is a typical rate you will pay. A 4% fee is common. With account receivable financing, receivables must come from another business or government agency, not an individual. Your business must be open for at least 1 year to qualify for account receivable financing. With 401k financing, a 401k or IRA can be used as collateral for financing. You can secure a 5-year loan or in some cases even a line of credit. You can get financing for up to 100% of the 401k value. The actual percent you get approved for is based on the percent of your 401k that is rollable. Rates with 401k financing are usually less than 5%. There are no penalties for the rollover of your 401k. Credit's a non-factor with this type of secured financing, so you can be approved even if you have challenged personal credit. Here is how the 401 funding process actually works. First, a new corporation is formed. A retirement plan is created for that new corporation, allowing for investment by you from your old 401k into the new corporation. Funds are rolled over into the new plan from your old plan. The new plan purchases stock in corporation and holds it. Now the corporation is debt-free and cash-rich. With securities-based financing, you are using stocks and bonds as collateral for business funding. Most stocks and securities are accepted. You can typically secure between 70 to 90% financing against the value of your stocks based on types of stocks or bonds you have. Rates as low as 2 to 5% with this type of secured financing. You can get a loan or a working capital line of credit. Challenged personal credit acceptable, so you can be approved even if you have bad personal credit. With equipment sale leaseback financing, equipment owned free and clear is bought by the bank and leased back to you. The lender pays you for the equipment, then gives you terms to lease the equipment back from them. You can be approved for as little financing as $10,000 and as much as $2 million. Loan terms typically range between 12 to 48 months. Rates usually range from 5% to 21%. To get approved, you will need a 650 or higher FICO score. Equipment being used as collateral must be one piece of equipment worth a lot of money. Think medical equipment like MRI machines. Think large presses and other heavy-duty equipment used in factories. Small pieces of equipment can't be lumped together and used as collateral, such as office printers. Inventory financing is where you use your existing inventory as collateral for business financing. Loan amounts range from $150,000 to $500,000. The minimum inventory financing loan amount is $150,000. General loan-to-value is 50%, thus inventory value would have to be $300,000 plus to initially qualify. No lumped-together inventory like office equipment can qualify. Think of a huge factory with shelves of inventory. Think about a retail store that has their back section filled with shelves of inventory. These are perfect examples of industries in which inventory financing can be used. Rates are normally 2% monthly on the outstanding loan balance. 520 credit score or higher is required for approval. Purchase order financing is where you obtain financing to obtain the supplies you need to fulfill an order. Letters of credit are issued to the supplier guaranteeing payment. Up to 95% of a purchase order can be advanced. 5% less fee is released once the actual invoice is paid. Loan amounts typically range from $5,000 to $25,000. Purchase order financing typically offers interest rates of 1 to 4%. There are no credit score requirements to qualify. Purchase order financing cannot be for unfinished goods. Unfinished goods are ones that have not completed the manufacturing process. Commercial real estate financing is a type of secured financing in which commercial real estate is used for qualification. Loan amounts range from $75,000 to $20 million. 5% or higher interest rate is typical with commercial real estate financing. Owner-occupied and investment properties can qualify. SBA 504 and conventional loans are available to finance commercial real estate. With commercial real estate financing, you can be approved for a loan-to-value of 55 to 65%. 55% financing is available for cash-out refinancing. 65% loan-to-value is available for the purchase of a property. Business must have cash flow to make payments to qualify. 650 FICO credit score is required for approval. The applicant must provide a personal guarantee to be approved. With Book of Business financing for insurance agents, commissions from the Book of Business serve as collateral. Program is for insurance agents exclusively. State Farm agents won't qualify. Most other agencies will. You can borrow 2 to 3 times the amount of annual renewal commissions. Book of Business financing offers long-term loans of 3 to 10 years. 4 to 9% plus prime rates are typical. 650 credit score plus is required for qualification along with references. With floor plan financing, an auto vehicle floor plan is used as collateral. Revolving lines of credit and loans are available. When each piece of collateral is sold by the dealer, the loan advance against that piece of collateral is repaid. $25,000 to $250,000 loan amounts are typical for floor plan financing. 9 to 11% interest rates are typical. 600 FICO scores are required for approval. Strong references are also required. Loans under $250K don't require financials. Financing above $250K does require business financials. Unsecured financing is financing that is not secured by any kind of collateral. Nothing is pledged as collateral for the debt. If the borrower defaults, the lender can pursue the borrower legally, but they can't just take back any specific collateral. Unsecured financing examples on the consumer side might include credit cards. There are 2 main types of unsecured financing. Good personal credit financing will get you unsecured credit cards that do require a personal guarantee from you for approval. Good business credit financing will get you unsecured credit cards with no personal guarantee required for approval. With unsecured personal credit financing, approval amounts range from $10,000 to $150,000. No accounts report on your personal credit. Most report to business credit reporting agencies. Excellent personal credit with open revolving credit is required for approval. Low inquiries, usually 2 or less, are also required for approval. Approval amounts are usually equal to current limits on your existing credit cards. 0 to 25% APR is the standard interest rate, with 0% introductory rates offers for the first 6 to 18 months. With unsecured business credit financing, approval amounts from $10,000 to $50,000. These accounts report to the business credit reporting agencies. It will take 6 months to build your business credit profile from scratch to get these types of accounts. Personal credit is not used for pre-qualification on these accounts, so you can get approved even with severely challenged personal credit. Approval amounts are usually equal to current limits on your existing credit cards. 0 to 25% APR is the standard interest rate, with 0% introductory rates offers for the first 6 to 18 months. Revenue lending is one of the most popular current forms of unsecured financing, where you use your future revenue to qualify for financing. You can get approved even with no collateral. Revenue lending provides short-term loans of 6 to 18 months. Loan amounts are available up to $500,000. Loan amounts are equal to 8 to 12% of your annual revenue. Rates of 10 to 45% are common. A 500 credit score or higher is needed for approval. Good bank statements are needed, showing you manage your bank account responsibly is required for approval. Merchant advances are another popular form of unsecured financing. Merchant loan amounts equal to 1 month's volume. Loan amounts are equal to 1 month's of merchant processing volume. Rates of 10 to 45% are common. A 500 credit score or higher is needed for approval. Good bank and merchant statements are needed, showing you manage your bank account responsibly and have little chargebacks are required for approval. Contact us today to learn more about secured and unsecured business financing that you can get right now.